Taxes. Think about it this way. You've been working all month. Let's say you're flipping burgers at your local McDonald's. At the end of the month, you see that you've earned $2,000. Nice. But then you check your bank account. $1,456. Wait a minute, where did the other $544 go? You open your pay stub. Federal income tax, state tax, Social Security. Part of your money disappeared before it even reached your hands. And the strange part is this. It has become so normal that almost nobody questions it. Taxes are essentially the price of civilization. You pay taxes and the government builds roads, funds schools, and supports hospitals and public services. But that same government can also spend billions of dollars on things you never benefit from. Income tax is taken from the money you earn, sales tax from your purchases, and capital gains tax from the profits you make from your investments. Most people also pay Social Security taxes. Then comes the time to file your taxes. The government knows how much you owe, but it still makes you calculate it yourself. Come on, you figure it out. If you calculated it correctly, no problem. If you calculated it incorrectly, things can get complicated. Taxes can be annoying, but they're not entirely bad. Higher taxes can provide better health care, education, infrastructure, and public services. Banks. Imagine walking into a bank with $1,000. You deposit the money and think, great, my money is now sitting in a vault guarded by a dragon. Not exactly. Banks are actually intermediaries in the financial system. You deposit $1,000 and the bank uses part of that money to lend to other people. Maybe someone wants to buy a jet ski. The bank lends them the money and earns interest in return. The basic idea behind fractional reserve banking is this. Not everyone is going to withdraw all of their money at the same time. Banks make money by paying interest to depositors and lending that money out at a higher interest rate. The difference is the bank's profit. They also provide services like card payments and money transfers. In the United States, most bank deposits are insured up to $250,000 per person, subject to applicable rules. Interest. Imagine borrowing $1,000, but when you pay it back, you owe $1,280. Why? Interest. You can think of interest as the rent you pay for using someone else's money. When you borrow, it's a cost. When you save or lend money, it's your reward. Compound interest, on the other hand, is when the interest you earn also starts earning interest. In other words, your money is having babies. Imagine you have credit card debt with a 20% interest rate. If you miss your payments, the interest keeps accumulating. You buy a $12 burrito, and eventually it turns into a very expensive regret. But compound interest can also work in your favor. If you invest your money at 7% compound interest annually, it can grow significantly given enough time. That's why interest is the silent engine of both debt and wealth. With debt, it can turn small mistakes into major problems. With investing, it can turn small gains into large amounts over the years. Inflation, you go to the grocery store, you buy a bag of chips. It used to cost $5. Now it's $6.50. You've just met inflation. Inflation happens when your money loses purchasing power over time. Your $5 bill is still worth $5, but it can't buy as much as it used to. But why? Sometimes people have too much money and everyone wants the same products. But inflation isn't caused only by excessive spending. Supply chains can break down, energy and raw materials can become more expensive, and production costs can rise. Companies then pass those costs on to consumers. Then there are expectations. If people expect prices to rise even further, they may bring their purchases forward. Demand increases, prices rise, and the expectation can become self-fulfilling. A certain amount of inflation is normal, but when it gets out of control, the value of savings falls, wages fall behind prices, and purchasing power decreases. That's why governments and central banks often raise interest rates. Borrowing becomes more expensive, spending decreases, and the economy cools down. Recessions. You can think of a recession, in its simplest form, as a significant decline in economic activity. One day everything is going fine. You have a job, your bills are being paid, and you're planning a vacation. Then companies start laying people off. The stock market falls. People cut back on spending. Companies start cutting costs. But why does it happen? High interest rates, a global crisis, war, a pandemic. It could even be a container ship that gets out of control. Think of the economy like a party. During an economic boom, everyone is dancing, the music is blasting. Then the lights start flickering, real life comes knocking, and the DJ starts playing sad music about layoffs. Recessions hurt, but they don't last forever. Governments can cut interest rates or introduce stimulus programs. Eventually, spending returns, companies start investing again, and economic growth accelerates. Credit scores. A credit score is a three-digit number that tells lenders how trustworthy you are. It can affect how much interest you pay on a mortgage, car loan, or credit card. It's not really about whether you're rich or not, but whether lenders trust you. Scores generally range from 300 to 850. The higher your score, the more reliable you appear. Your score is affected by your payment history, credit utilization, the age of your credit history, and new credit applications. One of the most important things is paying your debts on time. Think of your credit score like a pet dog. Ignore it, and it can cause problems. Take good care of it, and one day it might help you buy a home. Even if you have no credit history, you can still have a weak credit score. So yes, the game can feel a little rigged, but once you learn the rules, you can use them to your advantage. Money or currency. One of the strangest things about money is that its value comes from our belief that it is valuable. People develop money to make trade easier. Instead of directly exchanging goods and services, we use something that everyone accepts. A dollar can buy something, a stick can't. Because as a society, we've decided that the dollar has value, governments issue money, central banks manage the system, and people use that money to make purchases. If too much money enters the system, inflation can rise. If there isn't enough money circulating, economic activity can suffer. At its core, money is a social system built on society's shared belief and trust. Investing. Now you know what inflation is. So how can you protect your money from losing value? By investing. Investing is the point where you make your money work for you. Normally, you sell your time in exchange for money, but when you invest, you use your money to produce more money. Of course, there is a risk. Risk. Stocks are small ownership shares in companies. With bonds, you lend money to governments or companies and receive interest in return. Funds combine many investments into a single basket. With real estate, you buy a property and hope to generate income from it. Investing isn't about being lucky. It's about starting early, diversifying, and being patient. Most wealthy people didn't win the lottery. They simply gave compound growth decades to work. And yes, investing is risky. Markets go up, markets go down. But the biggest risk isn't simply losing money. The real risk is never investing and allowing inflation to quietly reduce the future value of your money. Value. This is a slightly more complicated subject, but it's something everyone should understand. Imagine you find an ordinary rock. Just a rock. Now imagine that same rock is shiny and yellow. Gold. Because it's rarer, people assign a much higher value to it. But in the eyes of nature, gold isn't actually more valuable than an ordinary rock. It's more valuable because people value it more. This is an important part of understanding how people become wealthy, because if you create a lot of value, you can make a lot of money. Think about Steve Jobs, for example. He helped create a product that people considered valuable. Millions of people were willing to pay thousands of dollars in exchange for that value. Doctors and lawyers earn high incomes for the same reason, because the services they provide have high value to people. This is also why Gucci or Louis Vuitton can sell a similar-looking bag for a much higher price. People perceive these products as more valuable. And here's the interesting part. If you can figure out how to create value, you can make a lot of money. Time. Time is probably the most valuable asset you have. Almost everyone starts life with plenty of time, but no one has unlimited time. Most people sell their time directly in exchange for money. You work for an hour. In return, you receive a salary. Simple math. But high-income people make their time more valuable through skills, leverage, and systems. Wealth isn't built in a few days, it is built over decades. The money you invest today doesn't just grow, it can compound. Slowly at first, then faster and faster. That's why even someone earning an ordinary salary can accumulate significant wealth over their lifetime. They didn't beat the system, they used the system. Because small amounts of money invested regularly can turn into surprisingly large amounts when given enough time.